On June 16, 1933, Franklin Roosevelt signed the Banking Act of 1933, the law now remembered as Glass-Steagall, in a Washington that had already watched more than 9,000 banks fail since the crash. The official account is straightforward. Depositors had been ruined by reckless bank management, so Congress separated commercial banking from investment banking and built federal deposit insurance to restore public trust. That version is accurate as far as it goes. It is also incomplete in a way that matters. For more than a decade before that signature, there was no federal law stopping a bank holding your savings from also running a securities dealership 2 floors up, staffed by commissioned salesmen, selling bonds it had underwritten to the same customers whose deposits funded its lending. Nothing about that arrangement was hidden. It was public, profitable, and entirely legal. The record does not simply ask why Congress finally acted. It asks why nothing had stopped this for 11 years, and what the banks that built the arrangement stood to lose when it ended. The answer sits in ledgers, hearing transcripts, and congressional debate that survived intact, waiting for anyone willing to read past the headline about a single dramatic signature in June. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. By the time Roosevelt reached the signing desk, the country had already lived through a national bank holiday he had declared on his second day in office, closing every bank in America for 4 days simply to stop the run that was emptying vaults faster than tellers could count the withdrawals. More than 5,000 banks had failed between 1930 and 1933 alone, on top of the thousands that had already failed earlier in the decade in the agricultural collapse that preceded the crash. Depositors who had trusted a bank with their savings had no legal guarantee that money would still be there in the morning, and a growing share of the public suspected, correctly in a number of documented cases, that some of what had vanished had not been lost to bad luck at all, but moved deliberately from a bank's own risk into a customer's portfolio before the losses became visible on anyone's ledger but the depositors. To understand what stopped nothing, you have to understand what commercial banks had built inside themselves during the 1920s. National City Bank of New York, the largest bank in the country by the middle of the decade, had organized a securities affiliate called the National City Company as early as 1911. Under Charles Mitchell, who became the bank's president in 1921 and its chairman in 1929, that affiliate stopped being a quiet subsidiary and became the engine of the institution. Mitchell built a sales force of close to 2,000 people spread across branch offices, trained not to advise depositors, but to move a monthly quota of bonds the bank itself had underwritten. Tellers who spent the morning accepting deposits spent the afternoon pitching securities across the same counter. The bank's lending was supervised by the comptroller of the currency. Its securities affiliate answered to almost nobody, because National City Company was chartered as a separate corporation under New York law, outside the reach of any banking regulator. Chase National Bank ran the identical structure through Chase Securities Corporation under its chairman, Albert Wiggin. Between the two of them, National City and Chase controlled a sales channel that reached directly into the deposit relationships tens of millions of Americans already trusted, and used that trust to move product that had nothing to do with keeping a customer's money safe. Safekeeping and speculation were not merely housed under the same roof. They shared a name, a lobby, and very often a bonus pool. The commission a bond salesman earned for placing a risky foreign issue with a depositor was frequently larger than anything the bank earned on that same depositor's savings account in a year. The incentive ran in one direction only, and every officer in the building understood it. The affiliate model was not confined to National City and Chase. Guarantee Trust, Bankers Trust, and dozens of smaller regional banks had organized comparable securities arms by the middle of the decade, each built on the same premise, that a bank's deposit base was itself a distribution network worth more than the interest it paid depositors to hold on to it. Bond salesmen were frequently paid on a graduated commission tied to volume rather than quality, which meant a salesman earned more for placing a risky, high-yielding foreign bond than for recommending a safer government issue that paid the bank and the salesman less. Branch managers were given monthly sales targets passed down from the affiliate's head office, and those who exceeded quota moved up the ranks of an institution where selling securities, not managing deposits, had become the surer path to promotion. The affiliate structure did more than move product. It let a bank exceed lending limits that federal law placed on how much it could extend to any single borrower. A bank that had already lent a large corporation the maximum its charter allowed could route additional credit through its own securities affiliate instead, buying that same borrower's bonds with funds raised from public investors rather than from the bank's own deposits, while the underlying exposure to a single shaky borrower kept growing. On paper, the bank's loan book stayed within its statutory limit. In practice, the combined institution, bank and affiliate together, was carrying concentrated risk that no regulator examining the bank's ledger alone could see, because the ledger that mattered was sitting in a separate corporation across the hall. What the record shows once the Senate Banking Committee began pulling files in early 1933 is the part the official narrative tends to skip past. Ferdinand Pecora, a former New York prosecutor who took over as the committee's chief counsel in January of that year, did not simply confirm that banks had made bad investments. He documented, with subpoenaed correspondence and sworn testimony, how the affiliate structure had been used to move a bank's own bad decisions off its books and onto the public. National City Company had underwritten and sold Peruvian government bonds through the late 1920s, even as the bank's own credit officers privately doubted Peru's ability to service the debt. Peru defaulted in 1931. The bonds had carried National City's name and its retail sales force behind them, and ordinary buyers who trusted that name lost most of what they had put in. Pecora entered into the record internal National City correspondence in which the bank's own Peru specialist had cautioned, in writing, that the country's finances rested on a government with a weak record of repayment and a history of political instability serious enough to threaten any long-term bond. The sales literature the affiliates' brokers carried into branch offices across the country described the same bonds as a sound and attractive investment for the conservative buyer, without qualification. The gap between the internal memorandum and the sales pitch was not an oversight. It was two documents produced by the same institution for two different audiences. One told the truth as the bank's own analysts understood it, and the other was handed to the customer. Pecora would later describe this particular contrast between the confidential memorandum and the public prospectus as the single clearest piece of evidence the committee uncovered in the entire investigation, more damaging in his own estimation than any of the tax questions that eventually put Mitchell in a criminal courtroom. The more damaging pattern involved Cuban sugar. National City Bank had lent heavily to Cuban sugar producers through the early 1920s, when prices were high and the loans looked sound. When sugar prices collapsed later in the decade, the bank was left holding tens of millions of dollars in loans it did not want to write down. Rather than absorb the loss, National City Company packaged a large share of those same loans into bonds and sold them to the public in 1927, marketed as a fresh investment rather than disclosed as a bank, offloading its own bad credit. Pecora walked Mitchell through the transaction line by line at the hearing table. Mitchell's own testimony conceded the mechanics while insisting nothing improper had occurred, since nothing in the law required otherwise. The sugar producers on the Cuban side of those original loans did not benefit from the conversion. Their debts had simply changed hands from a bank that could absorb a loss over time to a scattered public of bondholders with no leverage to renegotiate anything, and when sugar prices fell further in the early 1930s, the bonds collapsed in value alongside them, leaving both the Cuban producers and the American retail buyers holding the consequences of a price collapse that National City itself had been the first to see coming and the first to walk away from. The hearings also reached into Mitchell's personal finances, and here the record turns from institutional to individual. At the close of 1929, with National City's stock price collapsing, Mitchell sold a large block of his own shares to his wife at a loss, which he then claimed against his income taxes, before quietly reacquiring an equivalent position soon after. Pecora produced the transaction records at the hearing in February of 1933. Mitchell was indicted for tax evasion that same year. A criminal jury acquitted him in 1934, but the Treasury pursued a separate civil claim, and Mitchell ultimately paid back taxes and penalties exceeding $1 million. He had resigned from National City before the criminal trial even began, his name by then inseparable from the hearings. The hearing room itself became part of the record in ways the committee had not planned for. When J.P. Morgan Jr. testified in the last week of May 1933, the session drew such a crowd of reporters and spectators that a circus press agent, working the corridor outside, arranged for a performer from the Ringling Brothers show, a woman named Leah Graff, to be photographed seated on Morgan's knee during a recess. The image ran in newspapers across the country the next morning, next to sober coverage of sworn testimony about tax avoidance and preferred stock lists reserved for the politically connected. The hearings had become, simultaneously, a forensic examination of the banking system and a public spectacle that millions of Americans who had never owned a share of stock followed as closely as any trial in the decade. That combination, credible evidence delivered inside an unavoidable public drama, is what gave Pecora's findings the political weight to move a bill that had stalled in committee for the better part of a year. If National City supplied Pecora's case against selling bad assets to the public, Albert Wiggin supplied the case against something closer to betting against your own depositors. In the months before and during the crash, Wiggin arranged for family holding companies under his control, among them a corporation named Shermar, to sell Chase stock short. As Chase's share price fell through late 1929, those short positions paid out, and the record that Pecora entered into the hearing showed Wiggin's family interests profiting by several $1,000,000 from the collapse of the very stock that Chase Securities Corporation was, at the same time, distributing to ordinary investors as a sound holding. Wiggin had drawn a salary and pension from Chase that made him one of the highest-paid men in American banking. He retired the year the hearings concluded, his pension intact, since nothing in the banking law of the time barred an officer from shorting his own institution's shares. The people who bore the cost of all of it were rarely the people in the hearing room. Bank stock in this period carried what was called double liability, a provision under which a shareholder whose bank failed could be assessed for an additional sum equal to the par value of the shares already owned, on top of whatever the stock itself had already lost. A depositor who had trusted a National City branch employee's recommendation, bought the bank's own stock as a sound investment, and then watched the price collapse could be legally required to hand over a second payment simply for having owned it. Mitchell drew a salary that reportedly exceeded $1,000,000 in 1929, even as that same stock fell by more than 80% over the following 3 years. Wiggin's pension from Chase was contractually guaranteed regardless of the bank's performance. The mechanism that had generated the losses and the mechanism that determined who absorbed them were not the same mechanism, and nothing in the law of the 1920s required that they be. None of this required concealment, and that is the detail the standard account underplays. The affiliate structure was disclosed in prospectuses, described in annual reports, and discussed openly in the financial press throughout the 1920s. The Federal Reserve had the authority to examine member banks, but no clear statutory authority to examine their securities affiliates, a gap that had existed since the affiliate model first spread after the First World War. The Comptroller of the Currency raised concerns as early as 1931 about banks using affiliates to evade lending limits, but had no power to compel a structural separation. Every regulator who noticed the arrangement could describe it. Part of the reason traced back to the McFadden Act of 1927, which had loosened branch banking restrictions and, in the process, left the question of affiliate oversight essentially where it had been before, a gap Congress had noticed and chosen not to close at the one moment closing it might have been easiest. The dismantling required a different act of Congress, and that required a political fight that had almost nothing to do with sugar bonds or short sales and almost everything to do with two men who did not agree on what the new law should do. Glass had tried before. He introduced versions of a bank reform bill in 1930 and again in 1931, both of which stalled in committee against opposition from the same banking interests that stood to lose the affiliate structure, and both of which predated any of the specific revelations Pecora would later produce. Glass was not reacting to a scandal when he first proposed separation. He had studied the structure on its own terms and concluded it was dangerous before a single subpoena had been issued. The scandal, when it arrived, did not create his argument. It gave his argument an audience large enough to move a bill that had already failed twice. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. Senator Carter Glass of Virginia, who had helped write the Federal Reserve Act 2 decades earlier, had been pushing a bill to separate commercial and investment banking since 1932, before Pecora had produced a single subpoenaed document. Glass distrusted federal deposit insurance as strongly as he distrusted the affiliate system, warning that guaranteeing deposits would reward poorly run banks at the expense of well-run ones and encourage exactly the kind of recklessness his separation provisions were meant to end. His original Senate bill passed without a deposit insurance provision at all. Representative Henry Steagall of Alabama, who chaired the House Banking Committee and represented a district full of small rural banks that had failed by the hundreds, wanted deposit insurance far more than he wanted separation, and he had the votes in the House to insist on it. Roosevelt himself was, in the early months of 1933, closer to Glass's position than to Steagall's, doubting that a federal guarantee was fiscally sound. Roosevelt's own doubts about deposit insurance ran deep enough that he reportedly told advisors he would rather see the bill fail than sign a guarantee that rewarded badly managed banks at the expense of the well-run ones, a position close enough to Glass's that for several weeks in the spring of 1933, it was not obvious the two chambers would reach any agreement at all. What shifted the balance was less economic argument than the ordinary math of a Congress, with more than 4,000 bank failures behind it. Steagall controlled the House Banking Committee and had enough rural and small-town support to keep any bill without deposit insurance from clearing the floor, while Glass controlled the Senate side and would not yield final passage without the separation provisions intact. Neither man had the votes to pass his version alone. Steagall's own district in southeastern Alabama had watched dozens of small unit banks close their doors through the early 30s. Institutions that had never underwritten a single Peruvian bond or organized a securities affiliate of any kind. Ordinary local banks that failed because the agricultural depression had already emptied the region's farms of income years before Wall Street's crash made the newspapers. For Steagall, the case for deposit insurance was not abstract. It was the difference between a farmer in his district trusting a local bank again or keeping cash buried on the property, and he was not going to let a fight over affiliate structures in Manhattan sink the one provision his own voters actually needed. What emerged from Conference Committee in June of 1933 was a deal, not a single coherent theory of banking reform. Glass accepted deposit insurance, administered through a new agency, the Federal Deposit Insurance Corporation, in exchange for Steagall accepting mandatory separation. Sections 16, 20, 21, and 32 of the finished act did the actual work. Commercial banks could no longer underwrite or deal in most securities. Securities firms could no longer take deposits. No firm could operate on both sides of the wall, and bank officers could no longer sit on the boards of the securities firms selling what their own bank had underwritten. Banks were given 1 year to choose a side. National City Company was dissolved. Chase Securities Corporation was liquidated. The House of Morgan split itself in two, with the deposit-taking bank retaining the Morgan name and a new firm, Morgan Stanley, spun off in 1935 under partners Henry Morgan and Harold Stanley to carry on the underwriting business under different ownership, and a wall of separation neither side could cross back over. The Federal Deposit Insurance Corporation opened its doors in January of 1934, insuring individual deposits up to $2,500 under a temporary plan that Congress made permanent the following year at a higher limit. Bank failures, which had numbered in the thousands in 1933 alone, fell to only a handful among insured banks the following year, and stayed at that level through the rest of the decade. The wall between deposit-taking and securities dealing held, more or less without serious challenge, for over half a century. That durability is itself part of the record worth naming, because it means the erosion that followed was not an accident of changing markets. It was a deliberate, incremental campaign, conducted mostly by the same institutions the wall had originally been built to contain. The record of that campaign begins in 1987, when the Federal Reserve Board approved a narrow reading of Section 20 that allowed bank holding companies to establish securities affiliates handling a small share, initially capped at 5% of revenue, of activities the original act had prohibited. Chairman Paul Volcker voted against the decision, on record as believing it began unwinding a protection the country had spent 5 decades relying on. He left the Fed later that year. His successor, Alan Greenspan, presided over the cap being raised to 10% in 1989 and to 25% in 1996. Each increase justified as a modest technical adjustment rather than what the cumulative record shows it to have been, a controlled demolition conducted 1 percentage point at a time rather than by a single repeal that would have drawn the kind of scrutiny Pecora once brought to bear. Pecora himself lived long enough to watch the first cracks appear. In 1939, 6 years after the hearings closed, he published a memoir titled Wall Street Under Oath, in which he set down his own account of what the subpoenaed files had actually shown, and warned in plain terms that the affiliate system's incentives had not disappeared, only been outlawed, and that an industry given enough time and enough lobbying budget would eventually ask for the law back. He did not live to see 1999, but the pattern he described unfolded almost exactly as he predicted. Greenspan himself supplied the closest thing to a formal admission the record contains. Testifying before the House Committee on Oversight and Government Reform in October of 2008, weeks after the crisis he had helped make possible reached its worst point, Greenspan told the committee he had found a flaw in the ideology that had guided his decisions as chairman, the belief that banks left to pursue their own interest could be trusted to protect their shareholders and their institutions without the kind of structural restraint the 1933 Act had once imposed. He did not connect that admission back to the specific votes he had cast in 1987, 89, and 96, raising the very caps that let bank holding companies rebuild what Glass and Steagall had dismantled. The connection was there in the record regardless, for anyone willing to trace it forward from the vote to the testimony. Through the 1980s and 90s, the banks that had been split apart in 1933 spent those decades arguing, consistently and in public testimony before Congress, that the wall no longer matched a financial system that had grown more competitive and more global than the one Glass-Steagall had regulated. The argument was not without merit. It was also being made by institutions that stood to gain enormous new revenue the moment it succeeded, a detail the testimony rarely dwelled on. Public disclosures compiled after the fact by campaign finance researchers put the financial industry's combined spending on lobbying and campaign contributions in the years leading up to repeal in the hundreds of millions of dollars, a sum no consumer advocacy group opposing repeal came remotely close to matching. The imbalance was not concealed. It was simply not the part of the story that made it into the floor speeches celebrating the bill's passage as modernization. The moment the argument succeeded arrived in April of 1998, when Citicorp, the direct descendant of National City Bank, announced a merger with Travelers Group, an insurance and securities conglomerate that already owned the investment bank Salomon Smith Barney. The combined company, Citigroup, was structured in open violation of Section 20 of the still-standing 1933 Act. Sanford Weill, who engineered the deal, did not disguise the wager. Regulators granted Citigroup a temporary waiver to operate the combined structure for up to 5 years, while Congress decided whether to change the law, and the merger's architects were betting, correctly, that Congress would act well before that waiver expired. On November 12, 1999, Bill Clinton signed the Gramm-Leach-Bliley Act, formally repealing the sections of Glass-Steagall that had forced banks to choose a side. The merger that had been illegal the year before it happened became, retroactively, the new template for how American banking would be organized going forward. The repeal itself passed by wide margins in both chambers, a lopsided vote that reflected 3 decades of steady lobbying rather than any last-minute persuasion, a bill whose outcome had effectively been decided years before the roll call that made it official. Weill himself supplied a coda to his own deal that few of the men in the 1933 hearing room ever offered. In July of 2012, 4 years after the crisis his merger had helped make possible, Weill told a television interviewer that the largest banks should be broken apart, separating the institutions that took deposits from the institutions that traded securities, essentially recommending in public that Congress restore the wall he had spent the better part of a decade lobbying to tear down. He did not frame it as regret over the 1998 merger specifically. He framed it as a judgment about what the system needed now, which is its own kind of admission, arriving from the man best positioned to know exactly what had been dismantled and exactly what it had cost to put back together. The television anchors interviewing him treated the comment as a surprising reversal from a man synonymous with the merger that made it possible. Inside the financial press, it was treated more soberly, as one more entry in a record that already contained Pecora's own warning in 1939, Volcker's dissent in 1987, and Greenspan's admission in 2008. 4 separate men, at 4 separate moments, each conceding in his own words what the ledger had been showing the entire time. What that template produced is where the financial thread reaches its present-day consequence. Within a decade of repeal, the largest American banks had rebuilt, at a scale the 1920s affiliates never approached, the exact structure the 1933 Act had been written to dismantle. Citigroup, Bank of America after its acquisition of Merrill Lynch, and J.P. Morgan Chase after absorbing Bear Stearns each combined deposit-taking, securities underwriting, and proprietary trading inside a single institution insured by the same Federal Deposit Insurance Corporation that had been created in 1933 specifically to protect deposits from exactly that kind of institutional risk. When the mortgage securitization market collapsed in 2008, the losses did not stay contained inside a securities affiliate that could be liquidated on its own, the way National City Company and Chase Securities Corporation had been in 1933. They sat directly on the balance sheets of banks holding federally insured deposits, which is a large part of why the government judged several of them too large to be allowed to fail, and extended support that reached into the hundreds of billions of dollars. The mortgage bonds at the center of the collapse had been originated, packaged, rated, and distributed largely by the securities arms of the same institutions that held the underlying mortgages and the deposits used to fund them, a closed loop that the 1933 Act had made structurally impossible to build. A bank that could not own a securities affiliate could not manufacture the very product whose failure would later threaten its own deposit base. That specific chain of exposure, a single institution creating the risk, selling the risk, and still absorbing the risk when it went bad, was the precise configuration Glass had warned about in 1932, restored in full 66 years after his bill first tried to prevent it. The Volcker rule itself did not survive the following decade unaltered. In 2018, Congress passed legislation easing several Dodd-Frank requirements for all but the largest banks, and in 2019, the regulators charged with enforcing the rule approved a simplified version that reduced the compliance burden for trading desks across the industry. Neither change repealed the rule outright. Both moved in the same direction. Every change to this body of law has moved in the 90 years since Pecora first opened his files, toward less separation between the deposits a bank is trusted to protect and the trading book it is free to run alongside them. Congress responded in 2010 with the Dodd-Frank Act, which included a narrower provision named for the same Paul Volcker who had cast the dissenting vote against the first crack in the wall back in 1987. The Volcker rule restricts banks from trading for their own account using federally insured deposits, but it does not reinstate the structural separation the 1933 Act had required. Banks may still own securities affiliates. They may still underwrite and distribute the products their own trading desks help create. The wall itself, the one Glass-Steagall built out of a political trade neither of them fully wanted, has not been rebuilt in the quarter century since it came down. What survives from 1933, largely unchanged, is the half of the deal that Steagall wanted more than Glass did. The Federal Deposit Insurance Corporation still insures American bank deposits today, its coverage limit raised from the original $2,500 to $250,000 per account, its basic function unaltered since the year it opened its doors. It is the institution that outlasted the compromise that created it, standing now as the one durable piece of a bargain whose other half, the actual separation between a bank that holds your savings and a bank that trades against the market with its own money, was dismantled 1 percentage point and one merger at a time by the same institutions the wall had been built to contain. Nothing about any of this required concealment then, and nothing about it requires concealment now. The mechanism by which a bank moves risk from its own books onto the public it is trusted to serve has been documented, litigated, testified to under oath, and in Greenspan's case admitted outright by the man who helped rebuild it. The record does not describe a scheme uncovered after the fact. It describes an arrangement that operated in plain view for 11 years before 1933, was outlawed for 66, and has now operated in plain view again for a quarter century since, insured the entire time by an agency built to protect the public from precisely the outcome the arrangement keeps producing. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.